Oh man, I don't know if I could keep up with that energy.
Bring it on. Get the chocolate.
I mean, he's done my job for me. I don't think I could do a better introduction, so I'm just going to scrap all the nice things I was going to say about you guys. But yes, we are talking about collaboration and how, between traditional financial services as well as fintechs, on how, basically we're revolutionizing the customer loan journey, or the customer experience, I think the cool kids say. But there's a lot to talk about. We've got a wealth of knowledge here. We've got some veterans of the industry, so we're going to jump straight into it. Sounds good? Good?
Sounds good.
All right, so Natalie, I'm going to pick
All
on
right.
you first, because let's face it, Bendigo Adelaide Bank, you guys have you're proud, traditional community bank. You've gone as far as saying there is no alternative to face-to-face personalized services. But at the same time, we can't ignore the fact that you are a success story when it comes to that kind of collaboration between, the incumbent traditionals as well as the fintech services, who, let's face it, are, it's just, they're gunning towards automation, data services, quick to decisioning, completely online, completely digital. I mean, we know the amount of work that you guys have done. Like, you've done epic work with Up, you've done great work with TikTok, not the social
They're here
media.
today, so
Yeah.
I hope they're happy to hear it.
Yeah, but not, or the, one of, the mortgage lenders, not the, social media services. So no Bendigo, Bendigo TikTok dancers. But I'm keen to understand, like, given that you have this emphasis on like face-to-face personalized lending, like, has this collaboration helped, I guess, like, augment and enhance that kind of service that you guys provide in terms of your customer loan journey, or has it kind of detracted from it?
I think it's definitely enhanced. If you look at the community bank model, which is very much, that's the core value. It's a really core value for Bendigo Adelaide Bank, which is caring about the customer and their community. So Bendigo is about a physical community, and then you've got Up, which has really created this virtual community. So that actual same core value is at the heart of both businesses. It's saying the customer is really important and the community that they're part of is really important. I think that where the collaboration with fintechs has really helped us on the Bendigo side is that we talk about now being human by design or digital by design and human where it matters. So we want to automate as many things and make it seamless for the customer to work with us to do whatever they want to do. And that's where the fintechs are helping us. But we want to still keep that community connection and caring about the customer. So the human where it matters is when you want to jump out and you want to talk to a real person, when you're a little bit anxious because it's your first ever home loan, or you've got something serious that you need to deal with, like a deceased estate, you want to be able to jump out at that point. So we want to make it seamless. So if you don't want to deal with us and it's all transactional and easy, we want to make that seamless, but we want to be there for you if you want to jump out.
Any of you guys want to weigh in?
Yeah, look, I think the relationship that you guys have got with TikTok and Up has been amazing to watch. I'm particularly interested in seeing Up's home loan journey come to life and how that's going to help a lot of first-time home buyers, etc. So, yeah, I don't know if you've got anything that you could share with everyone.
So the lovely thing about the Up Home Loan is it's actually a three-way collaboration across the three organisations. So it's an Up Home Loan offering. It's backed by Bendigo Bank. It's got Bendigo backend, but you've got TikTok helping with the origination process. So that collaboration has allowed us to get that to market really quickly, and the TikTok guys have done a fantastic job collaborating with both our Up teams and our Bendigo teams. So that one has allowed all three to work together, which has been quite special, yeah.
I mean, it couldn't have been all smooth sailings. I mean, with all the budding fintechs out here that want to, collaborate, like say with Bendigo Adelaide Bank, what are the kind of key learnings? What are the challenges, or any tips that you could share?
I think probably some of the key learnings around partnership needs to be equal. So it has to be beneficial to both sides, and maintaining that, and maintaining the customer at the centre of that. I think as a bank, I want the the fintech, so I'll talk as if I'm the customer for a moment. If as a bank, I want the fintech to provide me with something that's really easy to use, available quickly, and doesn't lock me in to be entangled with that vendor with a monolithic product for 10 years. I want to be able to buy that one little thing, that one service that the fintech's really great at. That's the thing I want to be able to do. And I guess that's where working with Jordan and the team at Experian, the Look Who's Charging example is a really good one. There was one service that they offered that was suited a particular need. I rang them up on the Thursday. By the Friday, they gave us keys to their sandbox, and it took 10 minutes for our team to verify that that service was what I wanted. But they didn't lock me in for 10 years to a contract. They didn't make me buy 50 other products within a monolith. I could just buy that one. And you know what? If their one isn't the best in another year or so, I'll just pluck it out and put something else in. So I think what I really want from fintechs and what works well is have something that's available now that I can use that isn't vaporware, and don't lock me in.
Yeah, that whole primary model's dead, right? It's all plug and play. If you've got the best data assets or best services, that's what people are going to use, right? Sean, I think this leads in perfectly to my next question. I actually had a really nice question to ask you, but I heard that the previous session you threw a curly one at the panel, so
bring it on.
I'm going to just, it's karma. I'm going to pay it back. So, Nano, relatively new entrance into the market, but you, Sean, you're an OG. You've actually been around for quite some time, like working directly in the fintech sector.
Yeah.
So here's my question, and I kind of think, keep this in mind. So it's been a recent shake-up within the sector. We've got some well-publicized, I guess, collapses of some of the neobanks, a lot of shedding of staff with, very promising fintech lenders and other non-bank lenders, and a lot of consolidation. So keeping that all in mind, thinking back to when you initially kicked off your journey within the fintech sector versus now, and now like basically a budding fintech lender provider. So what do you think is different collaborating with the traditionals maybe 5 years ago to now?
Oh, look, I think it's definitely got, the expectations have definitely gone up, particularly in this tough market that we're in, where there's a lot of economic uncertainty. Cap raises are a lot harder for fintechs. Just talking out there with pretty much everyone that's raising money at the moment. There's a lot of people going around, as they say, shaking hands and kissing babies just to try and to keep the lights on. So, and that when you're entering into a partnership as a fintech with a traditional, there's obviously expectation that your business model is strong, you've got a good capital base, and that you're going to be around to be able to service what your capabilities are that you're promising. So I definitely think it's got a lot more scrutinous. But then on the flip side to that, fintech has matured, right? So if you go back to 2017, so I started off life as one of the founding members of Volt. So we all, don't know if we all know, but Volt went through a pretty tough time recently, and that's still all playing out. But it's definitely gone, the maturity levels that traditionals and fintechs have experienced with working with each other over the last 5 years actually means that there's more precedent for traditionals to work with fintechs. So, you talk about contracts, you talk about all the legals, the boring stuff that no one sees that doesn't exist in any of the press releases. There's a positive in that regard that people are able to partner with people more easily.
You guys agree?
I was going to say, I think one of the things that we've seen from the fintechs over the last few years that we've been dealing with has been they've really rapidly come up that maturity curve in regards to how they talk to the more traditional players. So being able to have those conversations about what's a DR plan, what's the BCP, and all those sort of really fundamental building blocks that traditionals need to see to work with the fintechs. I feel like the fintechs have really grabbed that in the last few years, and that's been a bit of a boring behind the scenes sort of piece that's accelerated a lot of the collaboration.
Yeah, absolutely. Look, I think from I think the other point to add, the challenge that a lot of fintechs are going through dealing with the incumbents and the traditionals is getting the sales cycle right. So from our perspective, the home loan origination technology that we're selling into different banks and lenders at the moment, we go and speak to many lenders and many banks, and for that particular bit of technology, you don't know where they are in their journey in terms of looking to buy or build. But you still have to take part in the process of demoing, and one thing that's been really powerful for us is having the Nano Home Loans brand live with our technology. So whenever we're going in and we're showing our lending origination tech, we can actually put a live customer through, and we can show how it flows through in the back end. How that's going to make a lot of people's lives more easier at the traditionals, and it's going to ultimately faster time to yes, better unit economics, and better customer experience, which is kind of the holy trinity, right? And just one point to add, I think the biggest differentiator is that you can actually, you talk about the sandbox with Experian in 10 minutes. We delivered a core origination piece of technology for AMP in 115 days. Now, that's pretty quick, and we're only going to get faster the next time we do it. So, yeah, I think that fast and flexible implementation is also really important.
Apparently, there's another big unknown bank that you're about to roll out with. Could you drop the news here, or is this got a big exclusive from Nano?
That is top secret still, unfortunately. Yeah. That's APRA's fault, guys. So.
All right, Jordan, I haven't forgotten about you. I actually kind of kept you last because I think you've kind of got a unique position in terms of this panel, because obviously Experian, look who's charging you guys. You've got a long history of dealing with a lot of incumbent, the traditionals, but also obviously a big play into the fintech sector nowadays. I mean, obviously the acquisition of Look Who's Charging. I mean, we do a lot of work with you at Moneyplace, and a lot of investment in that sector. So I mean, Max, kind of really taking advantage of that vantage point. Like, what do you see? What are the key differences when you're dealing with, say, when you're collaborating with fintechs, and when you're collaborating with, say, the big traditional incumbents?
Yeah, I suppose there's a couple of really interesting differences, and probably some of them sound a little obvious at the surface, but when you think about speed, so you talk about engaging through a sales cycle, making a buying decision, contracting, delivering, doing the project. We see the fintechs, not surprisingly, move a lot quicker, generally speaking, than the traditional players, and oftentimes that's not because the team we're dealing with isn't motivated or isn't running at pace. It's about organisational focus. So for the fintechs, the whole organisations are often really focused behind a singular goal. Sean and the team were standing up a digital mortgage lending platform. That was what they were doing. That's what the whole company was doing. Oftentimes with the incumbents or the more traditional players, we've got a really focused team we're dealing with, but they're facing into, on their side, oftentimes shared services who are supporting 7, 8, 9, 10 really focused teams running at their 7, 8, 9, 10 really important focused things. So that's where we see some of those differences in speed. I think the other difference is, this is more from a vendor sort of perspective, but it's about certainty. So when we deal with a really large established player who's got an established business with consistent recurring profit, is quite stable, profitable, we sign a 3 or 4 year agreement with them. We're really certain that's going to come through. We're really certain we need to do what we need to do, but we're really certain if we do that they'll still be there in 3 years and the bills will be paid. For the fintechs, in many cases for them, we're dealing with companies who are pre-product, pre-revenue, pre-customer one. That doesn't mean we don't work with them. We absolutely do, but it means the way we approach and deal with them is just a little bit different. We focus a little bit more on shorter-term goals and shorter-term deliveries, and we try and avoid sort of getting ahead of the revenue too much, I suppose, in regards to how much we're sort of building and delivering. I think if I think about those differences and how the two different groups can work a bit better together, I think for me, the partnerships I've seen work really well are where both parties are really humble. So I think in many cases, you've often got two groups of really skilled, really qualified people coming together, and they've each got their own really deep areas of expertise. The partnerships that work really well are the partnerships where each partner respects the other's expertise and they create space for the other to add value into that partnership. So that sort of boils down to things that sound really boring. So roles and responsibilities, really clear accountability, and a really clear shared common vision of what does success look like. When we see those sort of things really locked in early on, that's when that collaboration, goes really, really well. When people not quite stay in their lane, but they really deliver their part and let the partners bring in their parts as well.
Surely you guys, is that accurate?
Look, I guess from our side, we had some fun throughout the process, Jordan. I think you're right in the sense that as a fintech, we're ready to move. And we wanted things yesterday, and the whole company is aligned to that one goal. So it probably does put a little bit more pressure on things when we're ready to go. So we had some interesting times around contracts and all that type of stuff. But I think overall the experience has been good. But I think to your point, you need to have a different model, right, to be able to interact with the fintechs to be able to satisfy their speed.
Yeah, and I would say that in many cases we feel like the fintech, and in many cases we are the incumbent, right? So in many cases we're moving a little quicker, and in some cases sometimes we're the ones moving a little slower, and we need to look at that model. But it's always a balancing act how we sort of flex, between those things while sort of maintaining what we have as really minimum sort of standards, which every large organisation does. But tailoring that is part of the magic of doing it well.
Natalie, are you guys the fintech in that relationship with Experian, or?
I couldn't help nodding to pretty much everything that Sean was saying about how you want to work together. And I thought it was lovely the way you described why some of the incumbents are slow. Where you get the advantage with the incumbent is you do have a bit more certainty. I mean, we will still die if we don't innovate, but there is that certainty. But we are slower, but we come with a lot of the rigour around having worked in a regulated environment for quite a long time. And those guardrails actually perhaps help fintechs not give them too much rope to hang themselves by. But we need each other, right? We need each other because us slow banks perhaps have that rigour and the experience, but we need the experience. We need the innovation from the fintechs. So as long as we all remain open-minded and want to work together, there's so much opportunity to succeed together. Rather than think of it as competing. If you think of it in terms of succeeding together, and you have that trust and the partnership, I think there's lots that we can do.
Absolutely agree on that point. I guess just to add to it, and it's probably something that both you guys do as well, is having a shared objective. And a lot of the time it's based around the customer or the end client, and making sure that you can deliver for them the right outcome in a timely and a very timely fashion. Particularly if you're a fintech, you've got a little bit more urgency in some of those regards at times. But one of the things that we found is, and that we talk about internally, is the outdated technology that some of the traditionals have, not all. Oh no,
I think we all have it. That's the legacy that we sit with. Yeah.
Legacy tech is probably in a lot of spaces across the traditionals, right? And being able to that actually leads to poor processes, which can lead to poor customer outcomes. So from our side, if you can get behind the fact that what you're doing is going to deliver a better customer outcome, you just need to kind of work backwards from there. To deliver the new tech that's going to get you to the end goal.
And I think there's a lot of foundational stuff that we have to consider there. So our back end will probably, for most banks, be something that's written in COBOL on some mainframe, and we want to now API enable that. But in the past, the access to that was really limited. And so if you now put a nice shiny new microservice on the front and create all these great new innovative channels and front ends, you have to make sure that you secure all of that back end, because suddenly you're opening up something that was closed for a really, very long time and has been protected because it was so closed. So there's all this other consideration. I have to think every day, will this risk our bank license? What's the risk involved in doing this thing? So there's always that balance in the background of yes, we want to innovate, but we need to do it safely and securely, because we're the most trusted bank in Australia. We want to maintain that trust with our customers, and we need to do that by protecting the data that they've entrusted us with. Yeah.
Big up for mentioning Cobalt on a panel. That's real cool. I'm going to pick on you just for a bit longer, Jordan. You get to see on both sides. You worked with both fintech and traditional incumbents. How could they play better to kind of really, what's your advice, or what could they be doing better to kind of really accelerate to that ultimate customer journey, customer experience when it comes to, well, lending?
Yeah, I think the biggest thing, and this probably goes back to, Sean, what you were saying, I think the biggest thing is working together. The best way to do that is for there to be a really clear mutual understanding of what each party's needs are. And those needs might relate to outcomes, they might relate to features, they might relate to timelines. And I think having a really clear understanding of what those are up front, and ideally where possible, making sure that they're understood and agreed by all parties, I think that really helps smooth out the process and ensure there's accountability on both sides. So if one party does commit to something, it's really clear that they're accountable for that over time. I think where things get difficult is where things aren't maybe really well and explicitly communicated. So it's kind of like a relationship. You need to share your needs, right? If you're not sharing your needs, you can't be too unhappy if the other person doesn't respect them. So I think that really explicit and open communication, and just not assuming that the other party is on board, not assuming that the other party will be able to do something at a timeline that you need, or the other party will be able to change so-and-so, or whatever it might be. The more you can say your needs, the more you understand how they can be met.
Yeah, look, I think I generally agree with that. I guess the only point that I'd have to add is around when you're having those open communications, you need to have the same counterpart in the other organisation that you're dealing with. So from a lot of lessons are everyone is a salesperson, and everyone believes that they understand the detail, but you really do need to get the people that have got the detail facing off to the other person that's got the detail in the organisation that you're trying to do a deal in, or you're trying to work with. Otherwise, you can waste a lot of time very quickly. And it kind of goes back to governance of partnerships, right? And if advice to anyone out there is, you need to establish that very early on. In terms of getting the right roles and the escalation paths, etc. Otherwise, you can land up in hot water pretty quickly.
I'm going to sneak one in. I think we've got enough time. So we're going to fast forward to 5 years from now. They invited you back on Intersekt. You're going to be on a panel, and you're going to be asked about, what do you think you'll be talking about in terms of the ultimate, top of the line customer experience when it comes to lending? Where is it coming from? What is it? Is it coming from the fintechs? Is it going to be coming from the traditional incumbents? Or will it be this grand collaboration between the two sectors?
Shall I go first?
You can.
I think it's going to come from the fintechs, and I think that it will come, but it will has to come through a collaboration if the incumbents want to survive. So it's collaborate or survive for probably my side of the fence. Otherwise, the fintechs will take it elsewhere. So that's where I think it's going to be. As far as the type of services, I think a lot more of novel type lending. We've probably talked a lot about different business as a service models that are developing now, that you provide the back end and somebody else can just go into your dev portal and develop their own thing at the front. So there's plenty of that type of lending that's emerging overseas and starting to happen here as well. 5 years down the track, maybe our kids will be, probably you guys don't have kids that old, maybe my kids will be going for their first home loan, and they'll just be doing a, hey Siri, find me go sign me up, use all my ID that's already on my phone to verify who I am, and I'll just say how much I want to spend, and I'm done. So who knows?
Yeah, look, it's probably true. Like, hey Siri, I've got a 3.5-year-old and they know how to use the iPad better than I do. So I think the slightly different angle, 5 years is not that long. Like if you said 50 years, then we're talking about getting a home loan, like by saying, hey Siri, in the metaverse somewhere, maybe. But 5 years, I think, in the economic cycle that we're about to approach is going to be, I think what we can hope for is that home loan process itself and the home loan product just maybe takes a bit more of a backseat. And actually the innovation sits more in the wider value chain. So maybe just do something very different, but in the audience, who has a home loan? Can you just put your hands up? Great. Who's had a problem with their home loan, or who's had a problem with buying a property in the past? There's a few. So there's a lot of the other panel sessions that we've had have been talking around some of the issues that are out there in the wider value chain. So making customers' lives easier further up the value chain. So when you're looking to buy, I think there'll be a lot of innovation that kind of tries to seep into that space, and you'll see home loan products becoming more of a commodity, and it will just be a ticket to the game. Like fast origination is going to become expected. Minutes, this whole 3 weeks to get a home loan is ridiculous. If we can get that to 10 minutes across the board, then I think that's where we should aim for in the next 5 years.
Yeah, I think thinking about the next 5 years, this is probably more of a hope than a prediction. But I think those trends you're talking about, Sean, in regards to being able to do things faster, quicker, lower friction, I think we're seeing right now things like CDR emerge. And I think there's an opportunity with these sorts of tools. What they're doing is they're sort of shifting that sort of fintech investment Overton window of like what makes sense to do. And I think that unlocks some things that maybe yesterday or 2 years ago didn't make sense to do from an economic point of view, or unit economic point of view, to support things around inclusion. So you think about, today a consumer who needs a $300 or $400 loan, their options are pretty limited. It's maybe they can BNPL it, maybe they go and get a short-term loan with a really high interest rate, and there's good reasons why they can't go to MoneyPost. I don't think you do $300 loans because the unit economics for someone like a MoneyPost to write that loan don't make sense. Something like a CDR, using all the data sources to deliver services at a much lower cost base will unlock new services that don't exist today. So these people who were previously pushed to the fringes of mainstream finance, and they take that short-term loan, they get that new tyre on their car, they then get excluded from the mainstream system because they have that on their credit history. If those people can be serviced in a more mainstream way, I think that'll really improve that inclusion aspect. So where I hope we are in 5 years is that there's a lot more people who have access to reasonably priced credit really quickly, and it's being provided by people who are doing it sustainably, profitably, in a way where they're actually doing the responsible lending checks and really taking care of their interests as well.
Thanks. I think 5 years is plenty of time, and we're going to get CDR in 12 months. So it's going to be great. It's open banking. It's going to change the game. And with that, man, guys, it's kind of out of time. I mean, I could talk to you guys all day, but big up to our really humble and expert panel.